Hi there. Today we're going to give you a crash course on capital, the third of the 5 C's of credit. By the end of the next few minutes, you'll know what capital is, why it's important to businesses and to ATB, and what capital looks like for higher risk clients. So to start with, what is capital? Capital is the money or the wealth needed to run a business. Basically, it's cash on hand or anything that a company can sell or borrow against to raise money if needed. For an individual borrower, capital is defined as their financial investment into their business that's at risk for the loan, plus their personal net worth. It's their skin in the game, their personal stake in the business. For limited companies, capital is the shareholders' contribution to the business, plus the business equity at risk. Owners who are personally invested are much more motivated to manage their company and to work with the bank during a turnaround. Now, for both individuals and for limited companies, capital also means, does the client have a financial cushion or the ability to quickly raise funds to continue to operate? Capital can be boiled down to 2 questions that you should ask for every loan deal. First, what is the owner's financial commitment to the company? And second, does the business have a financial buffer to make it through tough times? So next, what are the sources of capital? First, take a look at the balance sheet. What are the client's assets? Are they highly leveraged? What equity is left? Do they have operating funds for emergencies? So number 2, take a look at the shareholder's personal net worth. If the business is struggling, do the owners have personal resources that they can put into the company to keep things going? And lastly, the business earnings that are invested back into the business. Is the business reliably making money that they can put back in to keep operating? Now remember that for small to medium-sized businesses, they can't sell shares to raise money from the public market, although they may be able to bring in a private investor or a guarantor. So what happens if we don't understand a business's capital position fully before we grant a loan? Well, unfortunately, there are many stories of clients who don't have enough capital on hand. They rely too much on their day-to-day earnings, and then they don't have a backup plan for a bad year when sales and earnings are down. And there will always be bad years. These clients can end up in asset management and in bankruptcy. And that's bad both for ATB and of course for the client. It's up to you to understand a client's capital so that that doesn't happen. Next, I'm going to turn it over to Damian Schumack.
Thank you, Ron. I'd like to take a few minutes of time now to discuss some of the characteristics that we should observe with respect to a BRR 8 and a BRR 9 and the capital C of the 5 C's of credit. If at first we're looking at a borrower risk rating of 8 with respect to the capital C of the 5 C's of credit, what we will observe is an asset quality that's average to maybe slightly below average. Usually what you'll see is both a higher working capital need and a leverage position that's a little bit on the high side as well. The balance sheet metrics for a borrower risk rating of 8 will likely rank in the 3rd or 4th quartile of the industry comparables. And on the earnings side, you will have maybe less than stable or less than perfectly stable earnings and cash flow. Albeit at a borrower risk rating of 8, they are capable of servicing the organization's obligations. And I probably should clarify, when I say obligations, I'm not only talking about principal and interest obligations, but the obligations of running the organization. So at a borrower risk rating of 8, you should see earnings capable of servicing and covering those obligations, albeit there will likely not be a large excess of funds generated. Usually at a borrower risk rating of 8, access to outside capital is available, albeit selective. Companies will be able to possibly refinance at market terms and conditions, but it will be selective and not as easy as maybe a healthier risk rating as you would expect. If we're talking about a borrower risk rating of 9, what we should see is probably an asset base that's certainly below average. Balance sheet metrics will rank in the higher quartiles for sure, and both the leverage position and the working capital position of the company will be starting to encroach on a less than healthy position. Earnings with a BRR 9 organization will typically be sporadic. Losses might start to occur at that point in time, and the cash flow from the earnings might not be sufficient to fully cover all of the obligations of the organization. At this risk rating, access to outside capital will be very limited, and likely debts will not be easily refinanced within market terms and market conditions. If we contrasted a borrower risk rating of 8 and 9 with 5 through 7, for example, 5 through 7 you're seeing really healthy balance sheet metrics ranking in the lower quartiles of the industry peers. You're seeing asset qualities that are certainly better than average, probably less reliance on intangibles. You're seeing healthy and stable revenue streams and earnings and cash flows that are capable of servicing the obligations, as well as building up an equity base. At those healthier borrower risk ratings, access to outside capital is more than accessible, and refinancing debt obligations within market terms and conditions is certainly achievable and definitely easier. Thank you very much, and back to you, Ron.
Thanks very much, Damian. Now, hopefully, you understand a little bit better how capital, the third of the 5 C's of credit, can make or break a business, and why it's critical to look at closely for every application, and especially for higher risk BRR 8 or 9 clients. So if you're new to ATB and you want more help with the 5 C's when putting a loan deal together, or if you're an experienced lender and you've run into a situation that's unusual that you need to figure out, there are several places that you can go. First, in the wiki, search for strategic business rules to find minimum ratios and mitigation for each of the 5 C's, including capital. You can also visit the new Lending Considerations website to see how to look for the 5 C's for different types of businesses, plus the special considerations for BRR 8 and 9 clients. Also in the wiki, search for the 5 C's of credit for tips on items to include in your loan package. And finally, you can also check out the Business and Ag video presentation, Understanding Exceptions, which discusses lending to BRR 8 and 9 clients in more detail. Thank you very much for your time, and thank you for helping to make ATB stronger.